The United States and Israel launched strikes on Iran, nuclear sites, military infrastructure, a direct hit on one of the most economically sensitive regions on the planet. And within hours, Bitcoin dropped below $64,000. S&P 500 futures fell. Oil spiked 7%. Gold climbed. The Dow futures slipped. And somewhere in America right now, millions of people are staring at their investment accounts and asking the same question. What do I do? Do I sell? Do I hold? Do I move everything to cash and wait for this to blow over? Is this the crash? Is this the one that does not recover? Here is what I want to tell you before anything else. That panic you are feeling right now, rich Americans are not feeling it. Not because they do not have more to lose, they have significantly more to lose, but because they had a playbook for exactly this moment, and most ordinary Americans do not. Today we cover the playbook, what war does to markets, what history actually shows, what the wealthy do while everyone else panics, and what you should do, specifically practically today with your money. This channel covers wealth education and financial commentary. Nothing here is financial advice. Everything here is documented, data-backed, and more useful than anything currently running on cable news. Let us begin. Before we talk about your portfolio, let us understand the actual economic exposure here. Because this is not just a geopolitical event, it is a direct strike on one of the most economically critical regions in the world. Iran sits at the mouth of the Strait of Hormuz. That name probably means nothing to you. It should. The Strait of Hormuz is a narrow waterway at its tightest point barely 21 miles wide, through which approximately 1/3 of the world's seaborne oil passes every single day. 21 million barrels every day through a channel you could drive across in 30 minutes. Saudi Arabia's oil flows through it. Kuwait's oil flows through it. The UAE's oil flows through it. Qatar's liquefied natural gas, which heats homes across Europe, flows through it. If that strait closes, or even if markets believe it might close, oil does not spike 7%. It goes to $100 a barrel, possibly higher. Goldman Sachs has already said exactly that. And here is what $100 oil does to an American family. Gas prices climb quickly. Airline tickets jump almost immediately. Everything that gets shipped, which is everything, costs more. Inflation, which the Federal Reserve has spent 2 years trying to kill, comes roaring back. And when inflation comes back, the Fed cannot cut interest rates. And when rates stay high, mortgages stay expensive. And when mortgages stay expensive, the housing market freezes. And when the housing market freezes, consumer confidence drops. And when confidence drops, the stock market follows. That is the chain. That is why this morning's news matters to your 401k, your IRA, your Vanguard account, your Fidelity portfolio. The Hormuz chain is the financial risk hiding inside a military headline, and almost nobody on the news is explaining it this clearly. Now let us slow down because fear is useful for 30 seconds. After 30 seconds, it becomes expensive. I want to show you what actually happens to American markets during geopolitical crisis. Not what feels like it should happen. Not what cable news implies will happen. What the data shows across every major conflict since World War II. Deutsche Bank's global macro research team compiled this history. The results are not what most people expect. The S&P 500 has only crashed more than 20% following 2 geopolitical events in its entire history. 2. Hitler annexing Czechoslovakia in 1939, the Nazi invasion of France in 1940. Every other major conflict, Korea, Vietnam, the Gulf War, September 11th, the Iraq invasion, the 2014 Russia-Ukraine escalation, produced market drops that recovered within weeks to months. September 11th, 2001, the worst attack on American soil in modern history, sent the S&P 500 down 11% in 1 week. Within 1 month, it had fully recovered. The Gulf War in 1998, a direct military conflict in the same Middle Eastern oil region we are talking about right now, dropped the market roughly 15%, recovered within months. The 2003 Iraq invasion. Markets had already priced in the war before it started, and actually rallied when it began. This is what I call the panic premium. The fear before the event is almost always more expensive than the event itself. The investor who sold on September 10, 2001, the day before the attack, missed the recovery. The investor who sold during the Gulf War missed the recovery. The investor who sold in March 2020 when CO shut down the global economy missed the fastest recovery in S&P 500 history. Every single time, the investor who panicked paid for it. The investor who held was rewarded. History does not guarantee the future, but it does suggest something important. The people who get hurt in geopolitical market crashes are almost never the people who stayed. They are the people who left. This is the part of the video that I want you to really pay attention to, because right now at this exact moment, while the news is running its breaking alerts and the markets are sliding, two very different conversations are happening in America. Conversation one is happening in living rooms, group chats, comment sections. It sounds like this: should I sell? Is this the big one? I moved everything to cash last night. I can't afford to watch my 401k drop. Conversation two is happening in investment offices, family wealth meetings, private calls between advisors and high net worth client. It sounds like this: what is on sale? Where is the dislocation? Which sectors are oversold on emotion rather than fundamentals? Same event, same market. Two completely opposite responses. And those two responses, repeated across every crisis, every decade, are a significant part of how the wealth gap in America keeps widening. Warren Buffett said it in 2008, in the middle of the worst financial crisis since the Great Depression, when his firm Berkshire Hathaway was buying while everyone else was selling. He called it being greedy when others are fearful. That is not a catchy phrase. It is a documented, repeatable, historically verified strategy. In 2009, when the S&P 500 was at its lowest point, the wealthiest American investors were net buyers. The bottom quintile of American savers were net sellers, or simply absent from the market entirely. The wealthy bought Apple near its lows. They bought Microsoft. They bought Walmart when panic selling pushed it down with everything else. They bought Johnson & Johnson. And then they waited. I want to be honest about something here, because I think this point is often made in a way that sounds cruel, like the wealthy are smarter or better. That is not what the data shows. What the data shows is that the wealthy have one structural advantage that has nothing to do with intelligence. They have enough financial buffer that a market crash does not threaten their immediate survival. And that buffer, that cushion, is what purchases the ability to hold. The ordinary American who has no emergency fund, no liquidity, no financial buffer, that person cannot afford to hold during a crash, because if the car breaks down next month, if the medical bill arrives, if the job gets cut, they need that money, and they sell at the worst possible time. Not because they are foolish, because they have no choice. The survival sell is not a bad decision. It is what happens when you have no margin. And building margin before the next crisis is the real lesson of every crash. Let us talk specifically about what an Iran conflict does to different parts of your portfolio, because not everything moves in the same direction, and knowing which direction each asset moves is how wealthy investors find opportunity inside crisis. Oil and energy stocks. They go up when conflict threatens Middle Eastern supply. ExxonMobil, Chevron, Halliburton, these companies become more valuable because the product they sell becomes scarcer. This is not speculation. This is supply and demand mechanics applied to geopolitics. Defense stocks. They go up. Lockheed Martin, Raytheon, Northrop Grumman. Military conflict increases defense budgets. Increased defense budgets increase revenue for defense contractors. Investors who understand this dynamic were buying defense stocks before the first missile launched. Gold. It goes up. Gold is what investors call a safe haven asset. When uncertainty spikes, when nobody knows what happens next, money flows out of risk assets and into gold. It happened today. It happens every time. Now, the assets that go down, growth stocks, they get hit. Tesla, the NASDAQ heavy technology sector, high multiple growth companies. These are what markets call risk-on assets. When fear spikes, money exits risk-on assets. First, airlines. They crash almost immediately. Oil is jet fuel. Higher oil directly compresses airline margins. Emirates already suspended flights. Multiple carriers rerouting. This is not a prediction. It is already happening. Emerging market currencies, they weaken. When American investors get scared, they buy US dollars. That dollar strength weakens everything priced against it. This is the conflict portfolio map. Different assets move in different directions during geopolitical crisis, and knowing the map is the difference between reacting blindly and responding intelligently. The wealthy investor looks at this map and asks, what do I already own that is exposed? What should I be watching? The panicking investor looks at their total balance sees a red number, and sells everything. Same crisis, completely different outcomes. Enough context. Let us talk about what you actually do. Today, this week, in a world where the US and Israel are at war with Iran and the markets are moving on fear, the playbook has 5 steps in order of priority. Execute them in order. Step 1. Do not sell your long-term investments. Your 401k, your IRA, your index fund position built over years of contribution. Do not touch it. I know that feels wrong right now. I know the number on the screen is lower than it was yesterday, but that lower number is not a loss. Not yet. A loss only becomes real when you sell. On paper, you have lost nothing. In your account, the shares still exist. Every share of the S&P 500 index you owned yesterday, you still own today. The same Apple, Microsoft, Walmart, Johnson & Johnson, Berkshire Hathaway, still in the fund, still generating revenue, still paying dividends. The war has not changed their fundamental business. The share price deception, the price of your investment is not the value of your investment. Price is what the market is feeling today. Value is what the underlying businesses will earn over the next 20 years. Sell today and you convert a temporary price drop into a permanent wealth reduction. Hold today and you stay positioned for the recovery that history says is coming. Step 2. Check your cash buffer. This is the step that determines whether step 1 is actually possible for you. If you have 3 to 6 months of living expenses in cash, not invested, not in a 401k, sitting in a high-yield savings account or money market, you have the freedom to hold your investments through this volatility because you do not need to sell to survive. If you do not have that buffer, this crash is a symptom, not the disease. The disease is the absence of margin, and the prescription starting the moment this crisis passes is building that buffer before the next one, because there will be a next one. There always is. Step 3. Look at your exposure, not your total balance. Open your portfolio, not to check how much you have lost to understand what you own. Do you hold airline stocks, energy stocks, emerging market funds? Do you have significant exposure to high multiple growth tech? Understand your specific exposure to the Hormuz chain. Not to panic sell, but to knowledge in a crisis is the only reliable source of calm. Step 4. If you have dry powder, this is what it was for. Dry powder is the wealthy investor's term for uninvested cash held deliberately, waiting for exactly this kind of moment. Geopolitical sell-offs are almost always driven by emotion, not fundamentals. The business of Vanguard's total market index has not changed today. The revenue of every company in the S&P 500 is not materially different today than it was on Thursday. But the price driven by fear is lower. Lower prices on the same quality assets. That is not a crisis for the prepared investor. That is a sale. The crisis accumulation principle. When emotion drives prices below fundamental value, patient capital buys where panicking capital is selling. Step 5. Turn off the news after you have read it once. This sounds like small advice. It is not. The financial media's job in a crisis is not to inform you, it is to keep you watching. And the most reliable way to keep you watching is to maximize your anxiety. Every breaking update, every expert prediction, every worst-case scenario headline, all of it is designed to keep your cortisol elevated and your attention captured. None of it will change the correct decision for a long-term investor, which is to hold, not to sell. Information after the first read is just fuel for fear. The investor who checks their portfolio once today and then closes the app will make better decisions than the investor who checks it 43 times. I want to zoom out for a moment because the Iran crisis, whatever happens next, whether it escalates or de-escalates, is going to create a wealth divergence moment. These moments happen every 5 to 10 years. 2001, 2001, 2008, 2020, now 2026. In every previous wealth divergence moment, the investors who panicked and sold underperformed the investors who held, by a margin that compounded forward represents hundreds of thousands of dollars return on wealth. Not percentage points, hundreds of thousands of dollars. The investor sold in March 2020 when CO panic sent the S&P 500 down 34% in 33 days and moved to cash. Missed one of the fastest recoveries in stock market history. The S&P 500 was back to its pre-crash high within 5 months. 5 months. The investor who held, who did nothing, who sat on their hands, who turned off the news, was fully recovered by August 2020. The investor who sold was not. They were sitting in cash waiting for the right moment to get back in. The right moment never feels right. That is the trap. The re-entry problem. Getting out of the market during a crash is easy. Getting back in is psychologically almost impossible because the market always looks scary when you are standing outside it. The wealthy know this, so they never leave. Not because they are braver, not because they know something you do not, because they've been through enough of these moments to know that the exit, however temporary it feels, almost always becomes permanent. Here is the thought experiment I want to leave you with today. It is 20 years from now. The Iran crisis of 2026 is a chapter in a history book. The Strait of Hormuz either stayed open or was briefly disrupted, and then reopened because in the entire history of the Persian Gulf, including the Iran-Iraq war that lasted 8 years, the strait has never been fully closed. The S&P 500 has done what it has done after every previous geopolitical shock. It recovered, then it grew, then it compounded, and you are sitting in a chair looking at two numbers. The balance in the account of the person who held through February 28, 2026, and the balance in the account of the person who sold on February 28, 2028. Those numbers will not be close. One decision made today in a moment of fear compounded forward for 20 years. The market does not care about your fear. It rewards your patience, and it has been doing that through every war, every crash, every crisis for over 100 years. Today is a hard day to be an investor.